All right, Matt Davio back again with the One Minute Trader podcast. I'm happy to welcome an old friend, Darren Newsom, today. And Darren is a senior analyst with DTN. A lot of you know DTN as really content and analysts in the commodity space. Darren, how long have you been in the position, and why don't you give us your 2 cents on what you do?
I've been with DTN. It'll be the end of 14 years at the end of this year. And basically what I do is I spend my days watching all of the different market sectors. You know, most of our customers are ag based. But I have the luxury. I can watch the energies, financials, I can watch metals markets and see how all of these things fit together. Write up my analysis over the course of the day, send it out to our readers, kind of try to tie it into something that may be important to them. Why it may be affecting how corn's moving or cattle's moving or something like that. And then just keep an eye on how all of these things are changing, how our readers can use this to work for them in their businesses.
You know, it's the key points that you just brought in, and you've been doing this for 14 years. Mm-hmm. Correlations, non-correlations, what is changing. And, I'd love to talk to you a little bit today because of all this, Nobel Peace Prize about behavioral thought or behavioral economics as it relates to the markets and to trading. I've always believed that markets are run by people, whether it's the pit or it's a quantitative program on the back end. So, let's talk about that a little bit because things are changing and correlations are all out of whack, I would think, and probably you see the same thing. So what do you think's going on out there? And let's talk a little bit about your interest in behavioral economics.
Yeah, Matt, going back, a long time to win pit traders basically dominated the market. So anything 10 years or older, you could read the psychology. You could see, as certain, weather events or political events or news events happen, you could watch how the markets reacted, and you could get a feel for, if you had a direct line to the floor, you could hear the noise, you could hear the screaming, you could get this sense of what was going on. But all of that's gone. And you mentioned, that in the background of all this quantitative trading, of all this computerized trading, we still have those who are writing the programs. But to me, it has taken a lot of the psychology, a lot of those little behavioral quirks that humans have. It's taken them out of the markets. And I think a very clear picture of that is what we see, let's say, in the corn market these days. And what used to be more decisive, more explosive weather events over the course of the summer, we don't see that now. We see it to a certain degree, but not like what we used to back when it was more human driven.
Mm-hmm. So you think that it's not necessarily weather patterns have changed, mm-hmm. but it's the way that the traders consume the information that is maybe muting some of the volatility that was there?
I think so. I think what we're seeing is that all of this data is being fed into these algorithms, these trade programs, and it's coming up with different results than, say, you get 10 consecutive days of 100 degrees plus in Iowa. It used to send human traders just up the wall, and they would explode, and we'd have limit up days and this, that, and everything else. Well, now you put in, these programs where the only thing that they're really based on seems to be faulty USDA numbers, and since those aren't changing, right, computers have no reason to buy or sell. The corn market's just absolutely flat. So it's taking all of that human emotion, it's taking all of that psychology, the behavioral aspects out of the market. And corn's just one example,
right?
And others as well. It's taken that out of the market, and we have a much. I was just being asked earlier on Twitter, what's happened to the volatility? Well, it's gone.
Right.
With fund traders out of the market and not interested, volatility left with it.
Well, entirely true. I think I think we are generational lows when it comes to volume I don't think it's just ags. I think it's definitely, I mean, I know for a fact it is on the financial indices, the U.S. indices are seeing the lowest overall volumes that we've seen in 30 years. And so people go, is that true? And I'm like, yeah, it's like, trying to compare today. I mean, I've been trading for 27 years. So, but trying to compare today to 1993 to 1997 to 2000 to 2006 even, there's no like I cannot like even mirror it whatsoever, even slightly, the way markets behaved then and the way they behave now. So that makes me have to change my behavior as a trader, because it is behavior based, I believe. And it has become more and more difficult to perform, especially on shorter time frames.
Right. And it's interesting that you went back to kind of the cutoff time at 2006. That seems to be that key point when, that point in time when things change, when we diverge to a different path in the markets. That's when we really started to see this algorithm trading start to take over. I know it was predominantly in the ags back then, but even in the financials and the energies and so on and other commodities, it was that 2006 timeframe. And the seasonals, one of the things that I look at is seasonal patterns. I look at distribution patterns and all that, and you can't go back past, say 2006, 2007, because everything's changed. We don't see the normal, a lot of seasonality was based on old time supply and demand and the way that human traders perceived changes in supply and demand over a 12-month period. We don't see that as much anymore. And a lot of these seasonal cycles have flattened out, because it is more of a computer trade now, because there is other things, volatility, volume, headlines, these kinds of things, rather than just, markets rally during planting season, sell off during harvest. It doesn't happen that way anymore. You don't see the summer run up in the energy markets because of increased demand and then selling off through the winter. You've got more variance, but what's happened is it's just flattened everything out.
Right.
And all these patterns beyond 2006 are basically irrelevant.
So saying that, and I agree with you, they are irrelevant until they are not.
Right. Good point.
I try to put a finger on. I can't predict. I can't tell you what will be the thing that will bring volatility back into any and all markets, but I do believe it will come back. When that happens, how do you think that changes from this current environment, where I believe kind of, those that want to manipulate, to a flat and volatility environment, they feel like they've succeeded. But I think ultimately, the human behavior still overrides all the machines at the end of the day, because they're programmed by humans. And therefore, when those non-programmed events, even with AI that supposedly can learn, they still don't, it's hard to program emotion.
Right.
Okay. I believe. And that's going to be, now I've read and I continue to see that machines can learn emotion and then can program that. Well, I don't know. I mean, again, it's really not a conversation we can have, because I'm not intelligent enough to talk about it. But what happens when that volatility comes back into the marketplaces? Then what happens? I mean, how do you see that happening? Let's even look at a recent example, wheat and all the grains this summer. At late June on that USDA, you mentioned it. These reports, whether it's jobs, whether it's the crop reports, they're all bogus. GDP, they're all run through the FOMC machine. Right. Okay, so we don't have to talk about that. But it's real. But when those algorithms all get flushed out and we start moving again, like we did, I mean, how can you explain? So that this is a perfect example. In late June, we had these, basically we went from the lows of the year to the highs of 2 or 3 years in less than 2 weeks.
Right. We started that, and this is where I'm glad you brought this up, because to me that was a key test, because it started in the spring wheat market, a lighter traded market, where you don't have, there's still a lot of trade coming in from computers, but there is still the human emotion side of the spring wheat market. And so when we saw that was our normal weather event. That's what we used to see, in the entire grain complex, was when you get that long, extended, extreme amount of drought over a certain area, there was a great deal of concern over supply and demand. And so, yes, we exploded the market. So what's happened since then, though, is the winter wheat market, which is more heavily traded, has collapsed back down.
Right.
Really didn't have its supply and demand affected all that much. It was just riding the coattails of spring wheat. Spring wheat's still staying relatively strong. To me, what will be an even better test is if we ever get into a situation where we are challenging this supply that we've built up in something that's as heavily traded as corn. Mm-hmm. Will we see the computers basically switched off and we go back to human emotion? That volatility comes running back in. Traders want to get into corn, even if their algorithms are saying it's not the time to buy. We still have enough, all this and all that. Will the human side of something as large as corn, maybe even soybeans, kick in at that point?
Right.
That's what I want to see. But it's going to take a real threat to overall U.S. supply, something that we just haven't had basically since about the middle of 2000 and 2012, 2013, something like that.
Right. Yeah. So again, a war event, a true drought that nobody can deny, mm-hmm. a flood, and that the plains have never seen, whatever it is, right?
Yeah, because we've seen the same scenarios, play out in gold and the energy complex as well. Every week I put together a blog talking about weekly charts, monthly. I talk about monthlies. Yeah. And just almost every one of them, sideways trend, right. Not breaking out. It's caught in this range. And it's the same scenario. We have plenty of supply. I know there's a discussion going on right now about Brent crude going into, it's an inverted forward curve and all of this, indicating tighter supplies, but it's not going to last all that long. But we just can't build up the buying enthusiasm in commodities at all because of the oversupply situation, or the abundance, I guess is what some people want to call it, of just about every commodity we can think of. Gold kind of sits out there by its own. It's a limited supply situation. So what are those chaos events that can cause a spike? We get into Twitter wars with North Korea, or we threaten this or we threaten that, and gold reacts. So there's still a little bit of the old style trade going on in the gold market. But if you back up and take a look at its monthly chart, it hasn't changed all that much. It's still relatively flat.
Yeah, I couldn't agree more, and I still contend that when I look at the gold, and this is the only way I can even have a clear head on gold, because I agree with you. It's like every spike is sold. I mean, yeah, we're in a let's say 5 or 6 years kind of a range of $200 or $300, $1,100 to $1,400, right? So, right. But when you really pull back even a little bit further, you start to see that gold still has some work to do by economic theory, by the behavioral economic theory. Right. And there are a number of people that are still strong hands at that magic, par or 1,000 number. And I think that my opinion is that the behavioral side will shake those people out at some point. Before, and I'm sorry, gold bugs, but that has to happen until it can get, and it's also the same reason that has to happen before the market can take off. Mm-hmm. You have to trap everybody that's long, and there's too many people that are comfortably long right now still, right. Even though we've come from 19 whatever, down here to 1260 the other day. I still think we've got to see somewhere in that 600 to 800,
that would shake them out.
It would shake them out, right? So and it is actually, from my fundamental understanding, there's quite a few East Asian, Indian holders of gold, let's call it India, that are sitting on physical gold at 1,000 that probably have to be shaken out. Big hands, or bigger hands than me. Right. Which is not very big, but and it's the same thing I think we're going to see in the stock market. Nobody's long. Right. Nobody's long the stock market. At least they're not buying more and more and more. There's still cash on the sidelines. the market has to go higher because everybody's short on the professional side, and even I call it my new, this isn't my word, but the macro tourist name I love, because the macro tourist is exactly where we are. Everybody is smarter than me right now, and they all can see the writing on the wall that there's no way this is sustainable. The market can't keep going higher. Well, it's going to, because of that. The macro tourists are also short along with the professionals, which is forcing the market to drift higher until they capitulate and say, okay, fine, I'm going to buy. Because you know that, you know this, Darren, you can't have a blow off in any market without retail.
Right. Exactly. Yeah.
Right?
That's right.
Whether it's wheat, whether it's the S&P 500, whether it's gold, and right now retail is not involved. They're not involved in the U.S. stock market, and people will go, well, it's going higher. Yes, it is. And it's simply because volumes are decreasing and pros are just getting, every level just pinches them out a little bit higher almost every single day. It's one of from a economic behavioralist, it's one of the, the guys who study this stuff, it's got to be one of the most fascinating times to watch.
Well, yeah, and it's actually that branch of analysis that's saying exactly what you're saying, is that this is what it's going to take to wash everybody out. I mean, you got to get them out, and then and force their hand. Then this thing's going to turn around. But when it turns around, it's going to be brutal.
It's going to be swift, and it's going to be no. It literally. I mean, I think in our, and we'll see it in our life. You and I look to be about the same age, about 29.
Yeah, exactly.
and I think that we're gonna witness this, and it will be exciting. But I think that is the thing, that you're absolutely right. There's so many, and this is where the behavioral economics and market profile and TPOs show this clear as day, because I don't just look at price. I want to see how large the transactions were at all these different levels. And what you're seeing now is literally no volume and higher price, right? Yeah. Which is not a foundation you want to build a house on.
No, I mean, that goes back to some of the very basics of technical analysis. I usually fall more in the technical analysis camp. But if you have, this almost, parabolic rally going on, and volume and open interest are not increasing at the same time, that's usually a dangerous sign. You got a divergence there about new money coming in. It's not happening,
right,
as you pointed out earlier, and that usually creates a vacuum that has to be filled at some point. So when that vacuum starts to tumble, it's pretty tough.
So those are technicals. I'm more like, I really don't consider myself technical. I consider myself really an economic behavioralist. I'm a market maker. I like to think, what are people doing? And I like to fade. I fade the masses, unfortunately. So coming back to the fundamental side of things, because you look at that also, what are the farmers like? Where are they in this whole crossfire of stale and stagnation, right? How does this position them?
Well, from what I understand, most of them are still holding cash grain. So that could be some of last year's crop. And this is more in the corn and soybeans. Wheat farmers usually sell what they produce each year, for the most part. The corn and soybean guys, farmers, they're still holding some 2016s. One of the pieces on DTN today, you could actually see some 15 and 14 corn that still could be held in storage. And, they haven't forward contracted a huge percent, maybe no more than 50% of 2017 production. So they're long the cash market right now. And they're long a cash market in as we talked about earlier, a very quiet situation where futures markets aren't doing anything. Basis is weak because of the overall supplies that are out there. We look at the quarterly stocks numbers and these sorts of things. So actual cash basis, price difference between cash and futures has no reason to strengthen. And that leads to a relatively weak cash market at this point. So, we were talking about how you have to wash out a lot of these traders to get something to actually happen now in the stock market. Similar situation is, you won't really see the cash, you won't really see the grain markets go up again till you wash out all of these people continuing to hold on to their cash.
Right.
And until that happens, this market just stays stagnant.
And let's correlate the energy markets, because you look at those also. What do you see there? I mean, what do you see kind of I mean, I hate to say it, but it looks to me similar situation. We're kind of in this 25 to 60 area for the last few years. What are the producers, and how does that affect the farmer, as prices go up or down?
Yeah, to me, I can still build a technical argument for the energy markets to go down long term.
I agree.
We've still got plenty of supply, particularly domestically. I know that changes, particularly in like distillates or heating oil, whatever you want to call it. Gasoline's just a wild card. But if you look at, say, the crude oil market, we've got plenty of crude oil. We still have a carry in the forward curve. I still think that we're overpriced on the crude oil market. It's very similar to some of the grains. We've got an oversupply situation. It seems to be a bit overpriced at this time. I think it should go down.
Yeah.
But you've got to find that next catalyst to bring the sellers in to wash out those who maybe sitting there short already in the market. You got to wash out the weekends and then see if you can actually get the market to collapse.
Right. Yeah, and I think they've been trying to push it, to that, let's say $60, and they're just struggling. I mean, they're struggling to find more and more buyers up there, even though there's so many that are long. Yeah. It's a really weird spot. I agree with you. It's like long term, I think we've got to go back and test at least the low 40s, if not high 30s. Maybe not 25 again, but maybe.
Right. Yeah. Fundamentally, there's just no reason really to be sitting in this area. We don't have this huge demand coming up. Yeah, we're heading into winter right now. We're going to see a little bit more heating oil use, natural gas, these sorts of things. But for crude oil itself, I just think the supply and demand doesn't necessarily support where we are right now. These dollar jumps that we see on all of the craziness of what OPEC announcements are.
Yeah.
And then to find out, in the end, the actual fundamental news supports what we see in the spreads, and the fact that nobody's paying attention to the production cuts anyway. There's still plenty of crude oil coming into the market. So, I think these things are in time going to weigh, and there's a lot of money still long the crude oil market. I think this stuff's going to come to weigh on the market, going to push it down eventually.
Yeah, and I think I agree with you. I think there's you could argue there's a lot both long and short and pretty equalized, but I think that still is going to skew more to the long side. I think, because of that $150 tag that we saw, so many people are trapped and hoping, for some type of run to 100 or whatever it is.
We got to get back to 100 or 150, right?
It's almost like the Cisco situation. You're never going to see that price again, people. It's never coming.
No.
Cisco stock is, it's too big, and it's the same thing. Markets they're only so big. They can only take so much in price, and that was such a crazy situation that it's just not going to, it's not going to come back. So will we, then my next question to the puzzle is currencies. Mm-hmm. What are your thoughts there? Because you have to factor in import, export, currencies, US dollar, everybody's betting against it. Everybody's betting for it. It's the same thing. Like we're having the same conversation, aren't we? Over every single thing that we've talked about today, Darren.
Absolutely.
Yeah.
And this is the correlation that they're all behaving about the same, even though the old correlations, if this market moves, then this one should do this and that and everything else. But I've been a dollar bear for quite some time. Not necessarily good or bad, because the market really hasn't done all that much. I still thought it needed to weaken a little bit, looked like it had topped out on its long-term charts and so on. It has come down, and it's come down to the point, even though it's been slow and it hasn't been overly aggressive, it's come down to the point where it may not go down much more. So what that tells me is the fundamentals of the dollar could start to change. And the number one fundamental of the dollar, there's two. Number one, other world currencies continue to stink up the joint. Number two, the Fed starts to raise rates more aggressively.
I agree.
And if those two things happen, dollar starts to go up, and that puts more pressure on commodities, particularly commodities that have oversupply situations, which is just about everything that we've talked about here today.
Yeah, and so I agree with you. I'm macro bearish, but right now I'm like, it seems too. Again, the macro tourists are all bearish. Super long gold, super short dollar. It's too easy. It's been too easy. It's been too easy for the last 6 months again. We've got this short-term, nice little trend, and we, ran up to 100, and now we're back to, I think we rolled all the way down to almost, 90 something, 90 or whatever it was.
Right.
Yeah.
And I think that's probably going to hold it. I just don't think it just doesn't seem to have the momentum to push it much further than that.
Yeah. And again, the markets are always trap games.
Yeah.
Who can we trap? And I say this to people all the time. They often, non-participants look at me like I'm crazy, but I'm like, if you can't figure out who's trapped, you probably shouldn't be in the market. If you can figure out who's trapped and you can do it early enough, you will make a lot of money on those turns, right? Those turns when they trap those people. Oil going from 20 to 150 was a massive trap game.
Oh, it was, particularly, and it's something I wrote about in my column on DTN for Tuesday, last Tuesday. That was a brilliant trap. I mean, because you had all the talking heads coming on television. We were at 120, it was going to 150, it was going to 200, but the spreads were headed the other way. The carry and the spreads was getting stronger and stronger all the time.
Right.
We had a large supply situation. It was a beautiful trap.
Yeah.
And it snapped because I think by the end of the year we were down to 30 or something like that.
Yeah.
It was. I still hold that one out as probably one of the best examples of just that sort of situation we were talking about.
So, if you were a 1 minute trader and looking for traps, where do you see some traps maybe that people aren't thinking about? Just give me if you can come up with one or two of them, Darren, that'd be great.
Well, just because it's the ones I'm most familiar with right now, it would probably be the corn and soybean cash situation. Those look like obvious traps to me at this point, and the dollar short. I think that's a trap. Because I can't help but think that thing's getting ready to go back up. And I think it's going to get those who are just adamantly bearish that market.
I will even take the dollar a stretch, and I have been long, and this dip here, from 94s back here to the 92s, I'm interested in buying again because I agree with you. I think 90 is going to hold, and if it doesn't, I'm wrong there. But if it, I think we're actually, and I don't even know if it's going to take, the Fed actually raising rates. I think it's just going to be one of those situations where the world stinks up everywhere else and the money's got to go somewhere. And I think that's where we are. And as these events like Catalonia and Spain continue to rise up, no pun, they will continue to force, that chase and the dollar. Then couple that with everybody short at the same time, the macro tourists and the pros. And I think you could, I'm going to say it right here with you, Darren, and we'll mark it 10, 11 of 17. I think we're going to see all-time highs on the U.S. dollar before it ultimately collapses.
Right. And I agree, because you're absolutely right. The situation in Catalonia, I think, is the tip of the iceberg. I think we're going to see a lot more disruptions, a lot more, I should say, geopolitical disruptions.
Yep.
And again, the least ugly dog in the contest right now.
Exactly.
Is the dollar.
Yeah. So we can talk all day about, our $22 trillion debt and all these things.
Nobody cares.
That we all know will never be paid off. We all know that. Like, there's no discussion. We're not even having that. That is sidebarred. It doesn't matter.
Right.
And coming back to where we started this whole conversation, Darren, this is what moves markets.
Right.
Right. And it has nothing to do with fundamentals. It has nothing to do with technicals. And
correct.
And do you understand how to behave in these markets? Because if you don't, you're both technicals and fundamentals will get you destroyed.
They can.
Yeah.
They can. In certain situations, you're absolutely right. They certainly can.
And again, I think that's really where we're going to come to where that point in you talked about it earlier. Then people have to get crazy irrational before you can get rational again.
That's right.
So, well, thanks for coming on today, Darren. I appreciate your time. This has been quite fascinating. We should do more of these. I think you and I because it's a good way for people to think about markets. I think, and without falling into the strict technical, strict fundamental. Both approaches have their fallacies and they have their truths, and really that's my goal here, is just to try to expose people to ways to look at the way things move. So I appreciate you coming on today.
Well, I really appreciate you having me on again, and it is a fascinating topic and a great discussion, I thought.
Thank you. All right. I am Matt Davio with the 1 Minute Trader, and Darren Newsom, thanks again with DTN for coming on today, and we'll talk again soon.
Thanks. Sounds good. Thanks.
All right.